Let me start with something that might sound shocking, especially if you've spent years following the standard investment advice everyone repeats. If you're planning to keep buying stocks in 2026 simply because that strategy worked for the last 40 years, you might be walking straight into one of the biggest financial traps of your lifetime. My name is Ray Dalio. For nearly 5 decades, I managed more than $124 billion at Bridgewater Associates, one of the largest hedge funds in the world. Over those years, I've watched markets rise and collapse, economies boom and break, and entire financial systems change direction. I predicted the financial crisis of 2008 well before it unfolded. I warned about the bursting of the dot-com bubble. I've studied and navigated nearly every major economic cycle since the 1970s. And right now, I'm about to say something that will make many investors uncomfortable. Stop assuming the strategies that worked in the past will keep working in the future. I'm not saying stocks are bad investments. I'm not saying the market will crash tomorrow morning. What I'm saying is much more important. The economic environment that made traditional investing strategies so successful between 1980 and 2020 is gone. That era is over. For 4 decades, investors enjoyed one of the most powerful tailwinds in financial history, steadily falling interest rates. In 1980, interest rates were around 15%. Over the next 40 years, they dropped again and again until they eventually reached nearly zero in 2020. That long downward trend created the greatest bull market many investors have ever seen. Every time markets dipped, central banks cut interest rates, cheaper money flowed into the economy, asset prices rose. Investors who simply bought the dip and held their positions were rewarded over and over again. But there's one detail many people ignore. Interest rates can only fall to zero once. Once they reach that floor, the environment changes completely. Today, we are entering a different economic regime, and the strategies that built wealth for decades could easily destroy it during the next 10 years. This isn't speculation. It's not a guess. My conclusions come from studying more than 500 years of economic history. I've analyzed the rise and fall of global empires, financial systems, and debt cycles going all the way back to the Dutch Empire. When you examine that long history, patterns start to appear. And right now, the economic machine is sending very clear signals. We are in the late stage of what's known as a long-term debt cycle. These cycles usually last between 75 and 100 years. When they finally reach their end, the results are rarely quiet or gentle. The last time the world experienced this stage was during the 1930s and 1940s. Before that, another major cycle ended in the 1860s. When these cycles unwind, entire financial structures shift. Governments struggle under enormous debt burdens. Currencies weaken. Asset prices move in ways most investors never expect. To understand what's happening now, you have to first understand how the economic machine actually works. Most people think the economy moves randomly. They imagine a chaotic system where good years and bad years appear without warning. But that's not how it works at all. The economy is more like a machine with clear inputs and outputs. When you understand the mechanics behind it, you can see patterns that repeat again and again across history. Over the past 50 years, I've studied those mechanics in detail, not just in the United States, but across different countries, different systems, and different time periods. What I've learned is that the economy is largely driven by 3 forces. The first is productivity growth. The second is the short-term debt cycle. And the third is the long-term debt cycle. If you understand those 3 elements, you understand most of what drives markets. Productivity growth is the simplest piece of the puzzle. It asks a straightforward question. Are we producing more value per person today than we did yesterday? When innovation increases efficiency, productivity rises. Businesses create more goods and services, incomes grow, and the economy expands. When productivity slows down, economic growth slows with it. The second force is the short-term debt cycle. These cycles typically last 5 to 8 years. During the expansion phase, people borrow money. Businesses invest, consumers spend, the economy heats up. Eventually, that growth begins to create inflation. To control it, central banks raise interest rates, borrowing becomes more expensive, spending slows down, economic activity cools. Then central banks lower rates again, borrowing becomes cheaper, and the cycle begins all over again. That repeating pattern is why recessions tend to appear every 7 to 10 years. It isn't random, it's simply the economic machine moving through its natural rhythm. But beneath those shorter cycles, there's another force operating quietly in the background, the long-term debt cycle. And right now, that cycle is reaching a dangerous point. Over many decades, debt accumulates across the entire system. Governments borrow more. Corporations borrow more. Consumers borrow more. Year after year, the total debt level rises. At first, this borrowing supports growth, but eventually the system reaches a point where the debt becomes too large to sustain. Payments become difficult to manage. Economic growth can't keep up with the interest obligations, and refinancing becomes impossible because interest rates are already too low. That's exactly where we are today. Across the United States, total debt, including government, corporate, and consumer obligations, now exceeds $90 trillion. Government debt alone is approaching $38 trillion, which is roughly 125% of the entire country's economic output, and the cost of servicing that debt is exploding. The federal government now spends more than $1 trillion every year just paying interest on existing debt, not building roads, not funding education, not supporting national defense, just paying interest. For the first time in modern history, those interest payments are larger than the entire defense budget. When that happens, it's a clear signal that the debt burden has reached an unsustainable level. And when a system reaches that point, only a few outcomes are possible. History shows that there are really only 3 ways a debt cycle can end. Every country that has faced this situation eventually chooses one of these paths, sometimes a combination of them. The first option is default. This is the most direct and brutal solution. Governments, companies, or individuals simply stop paying their debts. Loans go unpaid, banks collapse, investors lose money. Wealth is wiped out almost overnight. When defaults spread through a financial system, the destruction can be enormous. The second option is restructuring. Instead of refusing to pay completely, the terms of the debt are changed. A lender might be owed $100, but after restructuring, they agree to accept $50 paid slowly over a longer period of time. On paper, the system survives, but the reality is still painful. If you were the lender expecting the full amount, you've just lost half your money. The third option is inflation. This is the most politically convenient solution, and it's the one governments and central banks choose most often. Instead of openly refusing to pay their debts, they create more money. By printing new currency and injecting it into the system, the real value of existing debt slowly shrinks. Imagine someone owed $100,000 in 2020. If the currency loses half its purchasing power by 2030, that same debt becomes much easier to repay. In real terms, it's worth far less than it used to be. For debtors, inflation can feel like relief. For savers, it can be devastating. And if you study history, you'll see a very clear pattern. When governments face unsustainable debt, they almost always choose inflation. They rarely admit that's what they're doing. Instead, they give it softer names. They call it quantitative easing. They call it stimulus. They call it liquidity support. But the underlying reality is the same. New money is created, currency is diluted, and the purchasing power of savings quietly erodes. When that process begins, the dollars sitting in your bank account slowly lose value. The money in retirement accounts buys less every year. The savings someone spent decades building begin to shrink in real terms. That's the environment we are moving toward. And if your entire financial strategy is built around owning traditional stock portfolios, you may be positioned for a world that no longer exists. This is the part that frustrates me the most. Most financial advisors never talk about debt cycles. They rarely study economic history beyond a few decades. Many of them were trained in business schools that teach a single investment formula and treat it like universal truth. That formula is the classic 60-40 portfolio. 60% stocks, 40% bonds, rebalance every year and hold it for the long term. For decades, this strategy worked beautifully. Investors enjoyed steady growth, and advisors built entire careers recommending it. But the reason it worked had nothing to do with the formula itself. It worked because interest rates were falling. When interest rates decline, bond prices rise. At the same time, lower interest rates push investors towards stocks, increasing valuations. In that environment, both sides of the portfolio benefit. But today, the conditions that supported that strategy have disappeared. Interest rates hit their lowest point in 2020. From there, they began climbing rapidly. By 2022 and 2023, rates had reached levels around 5%. Even if they settle slightly lower, the reality remains the same. We are not going back to zero. The era of free money is finished. And that changes everything. When interest rates rise, bonds lose value. A 10-year Treasury bond can lose 10 to 15% of its price for every 1% increase in rates. If rates move from 4% to 6%, that bond could lose roughly 20% of its value. So the so-called safe portion of the portfolio suddenly becomes very risky. But the problem doesn't stop there. Stocks themselves are also priced at extremely high levels. The S&P 500 has recently traded around 24 times corporate earnings. Historically, the average valuation has been closer to 15 or 16. That means current prices are roughly 50% above long-term norms. If valuations simply return to their historical average, the market could fall around 30% without any major economic crisis. And if the unwinding of the debt cycle triggers a deeper financial event, the decline could be far larger. History offers several examples of this happening. During the Great Depression of the 1930s, the U.S. stock market fell nearly 89% from its peak. Investors waited more than 2 decades to fully recover in real, inflation-adjusted terms. During the 1970s, something different happened. Stock prices moved sideways for years. At first glance, it didn't look like a crash. But inflation quietly eroded purchasing power. Prices for goods rose 7 to 9% annually, meaning the real value of those investments fell dramatically. Someone who bought stocks in 1968 didn't break even in real purchasing power until the early 1980s. That's 13 years of watching their savings effectively shrink while advisors repeated the same message, stay the course. Japan provides another example. In 1989, the Japanese stock market peaked near 38,000 points. At the time, many believed it would continue rising indefinitely. Yet decades later, even by 2026, that market has still struggled to fully reclaim those levels in real terms. An entire generation of investors believe the simple idea that stocks always go up over time. Many of them spent their lives waiting for that promise to become true again. And this is the uncomfortable reality facing investors today. In a rising rate environment with extreme debt levels, the traditional 60-40 portfolio may fail on both sides at the same time. Bonds lose value as rates climb or inflation rises. Stocks struggle because high valuations eventually correct, especially when economic growth slows and debt begins to unwind. That means investors could face losses from both directions simultaneously. But the real danger isn't just the numbers on a chart. It's the human story behind those numbers. Because when portfolios collapse, it isn't just markets that suffer. It's people's lives. And there's one story in particular that perfectly illustrates how devastating this cycle can become. Let me tell you about someone I know. I'll call him David. David was the kind of person every financial advisor loves. Responsible, disciplined, and careful with money. By 2006, he was 52 years old and had done everything the financial world tells you to do. He worked hard, saved consistently, and trusted professional advice. Over 25 years, he had built a portfolio worth about $2.3 million. According to the projections his wealth management firm showed him, he was on track to retire comfortably at 62 with roughly $4 million. Everything looked perfect on paper. His portfolio followed the standard model almost exactly. 60% stocks, 40% bonds, diversified across major funds. He worked with a large, well-known advisory firm and paid them about 1% of his portfolio each year for guidance. That meant around $23,000 annually in advisory fees. In return, he received regular reports, charts, projections, and constant reassurance that he was on the right track. In 2006, I happened to sit down with David during a conversation about the economy. At the time, I was already deeply concerned about what I was seeing in the financial system. Housing prices were exploding. Banks were holding massive amounts of mortgage debt. Leverage across the system was increasing at a dangerous pace. I told him very directly that we were late in the debt cycle. I explained that the housing market was overextended and that a financial crisis was becoming increasingly likely. I suggested that he consider repositioning part of his portfolio to protect himself. But David didn't take the advice. His financial advisor told him there was no reason to worry. They explained that hedge fund managers often predict disasters because their strategies depend on betting against the market. They said the fundamentals were strong and that long-term investors should stay calm and remain invested. So David stayed the course. And at first it looked like the advisor was right. Throughout 2007, the stock market continued climbing. David watched his portfolio grow another 12% that year. His confidence grew along with it. He told his wife that the warnings had been exaggerated. After all, the charts looked strong and the experts seemed confident. With retirement approaching, they started making plans. His wife bought a new BMW. They booked a Mediterranean cruise they had always dreamed about taking together. David even began looking at retirement homes in Arizona where they imagined spending their later years enjoying warm winters and quiet mornings. Everything seemed to be lining up perfectly. Then 2008 arrived. Within 18 months, David's portfolio lost more than half its value. The financial crisis moved faster than anyone expected. Markets collapsed. Banks failed. Panic spread through the global financial system. His savings fell from $2.3 million to just over $1.1 million. 25 years of discipline and careful saving had been cut in half. David was 54 years old at the time. Retirement was only 8 years away. Suddenly, the future he had planned for no longer existed. His advisor told him not to panic. They repeated the same advice millions of investors heard during that period. Stay invested, don't sell, markets always recover. And eventually they did recover. But the problem for David wasn't whether the market would recover someday. The problem was time. The market didn't fully regain its previous levels until around 2013. By then, David was 59 years old. When he ran the numbers again, the results were painful. His retirement projections now showed that he was nearly $800,000 short of what he needed. So he delayed retirement. First, he pushed it from 62 to 65, then from 65 to 68. Then life added another unexpected challenge. His wife became seriously ill. Cancer treatments began, and even with insurance, the medical bills started piling up. Over time, they faced nearly $150,000 in out-of-pocket costs. To cover those expenses, David had to withdraw money from what remained of his portfolio. The Mediterranean cruise they had planned never happened. The retirement home in Arizona never happened. Years later, I ran into David again at a coffee shop not far from my office. He was 70 years old. Instead of enjoying retirement, he was still working. He managed a retail store nearby, wearing a name tag and helping customers with returns and discount requests. We sat down and talked for a while. At one point, he looked at me and said quietly, "I should have listened to you back in 2006. He told me his advisor had shown him charts and historical data proving that markets always recover and that staying invested was the safest strategy. Everything the advisor said sounded reasonable at the time. So I asked him a simple question. What happened to your advisor? David laughed. His advisor had retired at 58. He now lives in Florida and spends his days playing golf. And that's the part of the story that still bothers me the most. David wasn't careless. He wasn't reckless. He didn't chase risky investments or gamble his savings away. He followed the rules. He trusted professionals. He diversified his portfolio. He did exactly what conventional financial wisdom told him to do. And it still failed him. Meanwhile, the advisor collected millions of dollars in fees from clients like David over the years. When the crisis arrived, many advisors had already positioned their own personal money safely. They understood the risks. They just didn't share those concerns with their clients. The lesson here isn't about blaming one advisor or one decision. The lesson is about understanding that systems built for one economic environment don't always survive when that environment changes. And right now, we are entering a period where many of the strategies investors rely on may stop working entirely. History shows that when major debt cycles reach their final stage, traditional paper assets often struggle. But something else tends to survive, something many modern portfolios barely include anymore. And once you see the historical pattern, it becomes very difficult to ignore. If you go back and carefully study past debt crises, one thing becomes clear very quickly. When these cycles unwind, the damage rarely hits just one type of investment. Entire portfolios built on conventional wisdom often collapse together. Take the 1930s as an example. Most people remember the stock market crash, but stocks weren't the only assets that suffered. Corporate bonds defaulted in massive numbers as companies went bankrupt. Even some government obligations failed to deliver what investors expected. Traditional portfolios that relied on a mix of stocks and bonds didn't provide protection. In many cases, they collapsed alongside the broader economy. Yet while paper assets were falling apart, certain types of assets held their value surprisingly well. People who owned physical wealth, things like gold, farmland, or productive businesses, often managed to preserve their purchasing power when everything else was losing it. The same pattern appeared again in the 1970s. During that decade, inflation surged across the global economy. Interest rates climbed sharply, and bond investors were hit particularly hard. The 10-year U.S. Treasury bond lost more than 60% of its real value between 1,970 and 1,980 once inflation was taken into account. Stocks didn't offer much relief either. The market moved sideways for years. Investors who thought they were maintaining their wealth were actually losing purchasing power every single year. But some assets performed extremely well. Gold, for example, increased roughly 24 times in value during that decade. Energy companies experienced enormous gains as oil prices surged. Agricultural land doubled or even tripled in value in certain regions. Again, the same pattern appeared. When debt cycles reach their breaking point, paper assets struggle while physical assets tend to hold their value. What frustrates me about this is that none of this information is hidden. The data is public. Anyone can study the economic history of the 1930s, the inflation crisis of the 1970s, Japan's lost decades beginning in the 1990s, or the global financial crisis of 2008. The evidence is there for anyone willing to look. Yet most advisors rarely discuss it with their clients. And the reason is uncomfortable. If advisors openly explained how traditional portfolios performed during past debt crises, many investors would start asking difficult questions. Questions like, why am I paying 1% every year for a portfolio strategy that failed during every major debt crisis in history? That's not an easy question to answer. So instead, the conversation usually stays focused on charts showing long-term stock market growth and reassuring phrases like stay invested and the market always comes back. But history shows the reality is more complicated than that. And once you recognize the pattern, the next logical question becomes obvious. If traditional portfolios struggle during the end of debt cycles, what should investors actually own instead? After studying this problem for decades, I've come to believe that there are three core asset categories that tend to survive when the economic machine begins to break down. These aren't trendy investments. They're not quick ways to get rich. They are defensive positions designed to preserve wealth during difficult periods. And over the past 18 months, these are exactly the types of assets I've been accumulating. The first category is businesses with pricing power. Notice I didn't say broad stock indexes. I'm not talking about simply buying an index fund and hoping the market rises. I'm talking about specific businesses that have three critical characteristics. First, they have the ability to raise prices faster than inflation. Second, they generate steady cash flow that investors can rely on. And third, they control valuable assets or intellectual property that maintain their worth even when currencies weaken. During inflationary periods, those characteristics become extremely important. Look again at the 1970s. While the broader market struggled, certain companies thrived. Energy producers that owned oil and gas reserves saw their revenues explode as energy prices surged. When oil rose from around $10 per barrel to $80, those companies experienced enormous growth. Their costs increased somewhat, but their revenues rose far more dramatically. Agricultural businesses experienced something similar. Farmers who owned productive farmland saw the value of their land and crops rise as food prices increased. Utilities also performed relatively well because many operate under regulatory frameworks that allow them to pass higher costs onto consumers while maintaining stable profit margins. Then there are consumer staple companies with strong brands and dominant market positions. Think about companies like Procter & Gamble, Johnson & Johnson, or Coca-Cola. These businesses sell products people use every single day. When their production costs increase, they raise prices. Consumers may complain about paying more, but they still buy the products. Take Procter & Gamble as an example. The company owns brands like Tide detergent, Pampers diapers, and Gillette razors. If manufacturing costs rise 20%, they might raise prices 25%. Consumers might choose a slightly cheaper version of the same brand, but they rarely stop buying the product entirely. That's pricing power. Johnson & Johnson provides another example. The company produces medical devices, pharmaceuticals, and everyday healthcare products like bandages and pain relievers. Hospitals and patients don't stop purchasing those items simply because prices increase. Demand remains steady even when inflation rises. These kinds of businesses aren't designed to deliver explosive growth during good times. Instead, they act as stability anchors during difficult economic periods.